200.
Eh, may utang mo. So, may utang ka pa si.
Ebyo, sana pautangin mo muna ako ng 200.
Eh, may utang mo. So, may utang ka pa sa akin 800 eh.
Oh, mababayaran ko rin yun pag alis ko. Papuntang Saudi.
Saan punta ako na pupunta ng Saudi? Hindi ka na nakarating eh.
Oh, anong malay mo kung matuloy ako?
O, sige na. Oh, pero nga muna ng 200 ito.
Eh, nasa iyo pinagbenta ng pali.
Wala eh. Sige na't makalayas na lang to. Eh, 100 tong pera ko eh. Oh, sige.
100?
Hmm.
Oh, paano? Eh, di kulang ka pa ng 100. Ha?
Oo.
Oh, saka mo na lang ibigay.
Oh, teka muna. Pero lumalabas ako pa may utang eh.
Talagang may utang ka.
Paano?
200 ang hinihiram ko sa'yo eh.
Hiniram ka lamang eh. Ako pa makakaroon ng utang na ibibigay sa'yo.
Eh, sa sandali lamang, hindi kayo nagkakaintindihan eh. Hindi kasi kayo marunong ng arithmetic. Magkano ba inutang mo?
200.
Magkano binigay mo?
100.
Magkano kulang?
100.
O yun.
Paano 100 yung utang?
O bayaran mo.
O, ayan.
O yung utang mo sa kanya.
O yan.
Oh,
Ayan.
Oh,
Mas ka.
oh, paano ngayon? Demanos na.
o di manos. Akala mo maayos mo ako, ano ko, gago? Tarantado ka eh.
Bakit?
Paano na manos eh? Wala naman nilabas na pera yon.
Hindi naman kayo nag-usap ng matagalan?
If it's not obvious yet, our topic for today is about debts, specifically how to audit debts via the performance of substantive audit procedures. So welcome to today's training session about substantive audit procedures performed on debts. I've said it before in other training sessions, and I'll say it again now. This training session for debts focuses on certain substantive testing procedures only and assumes that no tests of controls were performed by the audit team. Tests of controls and their impact on substantive testing will be discussed in other training courses. The timing and extent of the audit procedures will not also be discussed because those matters depend on the results of the risk assessment procedures that we conduct during the planning phase of the audit. Even the nature of the substantive audit procedures will depend on such risk assessment processes. Accordingly, we will only be discussing the typical audit procedures performed on debt. Depending on the circumstances of your client, not all the procedures we will discuss here may need to be performed at all. Alternatively, additional procedures not discussed here may need to be performed to address the identified risk in your particular client. In other words, the substantive procedures we perform on debt and any account for that matter should be customized to the needs of our client. So what are our training objectives for today's session? At the end of this training, I hope that you would have gained a basic understanding of debts, learned about some of the common risks relating to debts, learned the principal audit objectives in auditing debts, learned about the substantive audit procedures typically performed on debts, and finally, learned about the common issues encountered in the audit of debts. This training will be conducted in the same order as these training objectives. So what are debts? I think everyone knows what debts are. Utang. There's no clearer word than that, I think. A debt is something usually in the form of money that is borrowed by one party from another party. Debt is called and presented in the financial statements in quite a few different names. Debts can be presented in the financial statements as either the current portion of long-term debt, loans payable, bank loans payable, borrowings, and many other names. Whatever name it is called, debt is a debt. It is an amount owed to another entity, usually a financial institution such as a bank, for an amount lent to the company or an individual. It is an obligation that needs to be repaid back. Debts are usually obtained for various reasons, such as for paying for large purchases or capital investments. When cash from operating activities is not enough to pay for them, or when there's not enough fund to finance the operating activities of the company. Key characteristics. These are purpose, terms, costs, risk mitigation, and settlement. Let's start with purpose. When entities or even individuals obtain debts, there's usually a purpose. We don't obtain debt just for the sake of obtaining debt. So we do not typically obtain loans just for the heck of it. We obtain loans for building our dream houses, to buy our dream cars, to finance our children's studies, etc. The same is true for companies. Companies obtain loans to finance their projects, to buy capital assets, or to finance their working capital requirements, among others. The next key characteristic is terms. Debts are typically accompanied by terms and duration. For example, how often is the debt going to be repaid? Is it monthly, quarterly, annually, or at maturity date? When is the loan expected to be fully paid? Within a year, after 2 years, after 5 years, etc. The next key characteristic is cost. Debts can cost the borrower in the form of interest. A lender will not typically give their money to another party without getting benefits from this action. After all, the lender could use the money to fund their own operation. So why give it for free to another party? So interest is usually applied to loans. The fourth key characteristic is risk mitigation. To mitigate the possible risk of losses from non-payment of debts, lenders usually require the borrowers to follow certain protocols, such as the imposition of collaterals or debt covenants. And finally, the fifth key characteristic is settlement. In what form will the debt be paid? Is it in cash or in kind? Where would the borrowers get the amount to be paid to the lenders? Would it get it from its normal operation, or from the sale of properties, or from another debt? So those are the 5 key characteristics of debts. So let's talk more about debts. First, let's talk about what are the typical processes or controls employed by companies in recording debts. Well-placed controls must be implemented over debts due to the usual magnitude of loans obtained by companies. Companies can have debts as one of the largest accounts in their financial statements. Examples of these companies are those highly leveraged ones, yung maraming utang. Companies depending on their needs could have only one or two debts in their books, or they could have several debts in their records. Regardless of the number of loans obtained, however, the typical processes in obtaining loans remain the same for most companies. So let's discuss these processes. The need to obtain a loan typically arises when there's a large project or large purchase the company needs to make, but the cost of which could not be financed by their operations. Sometimes, it is even the operating activities of the company that requires financing, so the company obtains loans to finance its working capital requirements as well. In this regard, the first step in a typical debt process is proposing to the management the obtaining of a loan for a particular project or large purchase. So who approves the obtaining of loan differs in many companies. In some companies, especially those privately owned and smaller and medium-sized ones, certain top officers, such as the president or the CFO perhaps, are given the authority to approve loans. In many companies, however, it is the board of directors who are tasked to approve the acquisition of loans. And in other companies, authorization thresholds are set for the board of directors and the top management. For example, any loan principal above 1 million pesos needs the approval of the board, while loans amounting to 1 million pesos and below can be approved by the top management alone without the need for the board's authorization. The proposal for the acquisition of loans should be accompanied by studies on how much the loan would be, where to get the loan, the interest rate, the repayment terms, etc. Once the authorized officers or bodies have approved the obtaining of loans, then the appointed officers who can negotiate, then the officers who can negotiate for the loans on behalf of the company are appointed depending on the authorization policy, either by the board or authorized officers of the company. Typically, the minutes of the BOD meetings contain the discussions about the proposals for the obtaining of loan, the authorization to obtain loans, and the appointment of officers who can negotiate the prospective lenders on behalf of the company. However, if authorization of the board is not required for obtaining loans, then other documents that would evidence the authorization of the loans should be examined. Once the loans had been obtained from the financial institution, then they are recorded in the company's books. So why do we need to understand these processes in obtaining loans? Well, because they would be useful when we decide to test the controls over debts. As I've said earlier, a company may have only a minimal number of loans payable in their books. They could even have only 1 or 2 debts at the end of the year. In this case, it would probably be most efficient to perform direct substantive testing on these loans. However, when the company has too many loans in its books, performing only direct substantive audit procedures on them may become time-consuming and therefore inefficient for the audit. Just imagine if there are so many debts, so the time that we have to spend in performing the substantive procedures will be too much. This is when the test of controls can be useful for the auditors when the debts are too many. Instead of performing audit procedures directly on the loan balances, we instead review and assess the processes the loans had to go through, that is from the initiation stage up to the recording stage, to determine if we can rely on the balances of loans recorded in the books, and also determine if we can reduce the extent of the substantive audit procedures to be performed on the debt balances. For example, we test whether the loans were covered by appropriate loan proposals, whether the loans had been properly approved by the board or authorized officers, whether the authorization thresholds were followed, whether management ensures that all loans are covered by loan agreements, or whether loans are recorded properly and on a timely basis, etc. However, as I have mentioned earlier, test of controls will not be discussed in detail in this series, or in this session, rather. We are discussing the debt process essentially just to give you an overview of debts and the typical processes these debts undergo through and how test of controls can be used by auditors in the audit of this account. It would be the direct substantive audit procedures that will be discussed in this training session in detail, as I mentioned earlier. But before moving on to the audit objectives and substantive procedures, let's discuss first the 3 common risks associated with debts or loans payable. Again, this list of common risks is not exhaustive. Other risks associated with debts exist, and they vary depending on our client's circumstances. However, we will only touch on these 3 common threats which we must be alert for, among other things, during our audit of debts. So let's discuss the first risk, which is the intentional understatement or even non-recording of debt and related interest. Companies are commonly more inclined to understate liabilities rather than overstate them because a highly leveraged company is not generally attractive to investors and creditors. For creditors, a high balance of payable may mean that the company is incapable of paying its liabilities on time, while for investors, a high balance of liabilities may be considered an indicator of a possible liquidity issue. An understated balance of debts will also lead to lower interest expense, which in turn could lead to better results of operations. So companies that desire to present better financial statements to their stakeholders may manipulate their liabilities by, for example, understating them or by not recording debts in their books at all, similar to what Enron Corporation did. If you are not familiar with this case, Enron hid its mountains of debts by using special purpose entities or SPEs. The SPEs, which Enron had an interest in, had large amounts of debts recorded in their books. According to the US SEC, these SPEs should have been consolidated with the financial statements of Enron because of their equity compositions. But because Enron did not consolidate the SPEs and did not make full disclosures about the transactions it had with them, Enron was able to hide the large amounts of debts from their investors and creditors. The Enron accounting scandal was so big that it shook Wall Street to its core and even changed the auditing landscape, with their auditors, Arthur Andersen, the biggest accounting firm in the world at that time, was forced to dissolve because of the scandal. As you can see by this example, auditors must always ensure that proper auditing procedures are performed to address this risk of understating liabilities, including debts and interest expense by our clients. The next common risk we will discuss is the risk of misclassified debts. So a few of you may think that properly classifying debts into current and non-current is not a big deal, but it is a big deal. To present better financial statements, some dishonest companies may recognize current debts as long-term to improve their working capital ratio, which essentially measures the company's short-term financial health. As we all know, a healthy-looking financial position and records allows companies to attract more investors and creditors. Erroneous debt classification is not always intentional, however. Sometimes, the company just forgets to update the classification of their debts, or maybe their accountant doesn't know how to properly classify the company's debts. Whatever the case may be, proper classification of debts is very important in presenting fair financial statements. The final common risk we will discuss is the risk of inadequate financial statement disclosures. PFRS enumerates all the required disclosures for borrowings and related borrowing costs in the financial statements. Other regulatory bodies, such as the Bureau of Internal Revenue, the Philippine Stock Exchange, the Securities and Exchange Commission, the Bangko Sentral ng Pilipinas, the Insurance Commission, the Cooperative Development Authority, and other regulatory bodies may require additional disclosures on top of those already required by the accounting standards. Related to these disclosures, borrowings or debts can either be as simple as one that is unsecured, interest-bearing, and payable over a certain period, or debts could be one with lots of restrictive covenants that need to be complied with by the company and disclosed in the financial statements. The latter type of debt needs to be looked upon more closely by auditors, since non-compliance with debt covenants usually results in the change of classification from long-term debt to current debt. Ensuring full disclosure in the financial statements cannot be emphasized enough. As proven by the Enron case, non-disclosure of important matters can sometimes lead to the demise of the company and its auditors even, just like what happened to Arthur Andersen. So let's move on now to the next topic of our training session, which is the audit objectives. Similar to other accounts that had been discussed in other training sessions, we as auditors need to understand and know the audit objectives in examining the account balance, before starting any audit procedure to have a more efficient and effective audit. If we don't know what our audit objectives are, then we might get lost and lose sight of the risks that we need to address during the audit. Because debts are usually large and therefore typically not paid in one lump sum, and also usually paid over a certain number of periods, lenders expectedly charge interest on them. Accordingly, debts give rise to interest expense and accrued interest payable as well. In this regard, all the audit objectives in auditing debt that we will discuss today will include and pertain to the related interest also. So let's briefly discuss each of the audit objectives, starting with the first objective, which addresses existence and occurrence. The objective states that we should ascertain that all debt on the balance sheet is a real debt due to creditors of the entity, and that all recorded interest on debt has accrued at the balance sheet date. You may think that no company would want to record fake loans payable in their books, right? After all, fictitious loans mean bigger liabilities and bigger expenses, which many people may view as not good indicators of the financial health of a company. So why is the first objective of auditing debts about ascertaining that all the loans and related interests recorded in the books are real and valid and not fake? Are there companies that could have recorded fake or not real loans payable in their books? Well, the answer is yes. Aside from, for example, erroneous classification of certain transactions to loans payable due to, say, incompetency or lack of proper review of the work of an accountant, other reasons for possibly recording of phantom loans may also occur. For example, it was reported in a foreign news how a phantom loan arose involving a company and their lender. According to the news, the company obtained a loan from a lender. The company then eventually fully paid this loan to the lender sometime in 1985. However, a month after the full payment of the debt, a fictitious loan account in the name of the company was created in the records for the same amount as was fully paid. Thus, the loans, while already had been fully paid, still appeared to remain outstanding. The phantom loan was uncovered when the company's auditors received a confirmation reply from the lender stating that the loan balance had been fully paid. So while phantom loans payable rarely occurs, it can still happen as evidenced by this case, or when there's a fraud that can be covered up by recording fake loans payable. So as auditors, we must always ensure that our substantive audit procedures will be able to address the risk of fake loans occurring or being recorded in the company's books. The next audit objective, which addresses completeness and cut-off assertions, is to ascertain that all the entity's debt at the balance sheet date has been recorded and all related interest expense that has accrued at the balance sheet date has been recorded. As mentioned earlier, the recording of phantom debts rarely occurs but it still happens. This next audit objective is somewhat similar to the first audit objective. While the first audit objective aims to ensure that all loans are real and valid, this audit objective adds another characteristic or criterion, which is time. Accordingly, not only do we need to ensure that all the recorded loans payable are valid, but we also have to ensure that all the valid loans are recorded in the proper accounting period. That is, there should be no loans obtained in the current year that are recorded in the following year, and there are no loans obtained in the following year that are recorded in the current year. As we have said earlier, understanding loans payable is more frequently committed than overstating them with fake loans. One of the more prominent accounting scandals which rocked the business world and which involved the understatement of debts is the case of the Lehman Brothers, a global financial services firm based in New York City. It was reported in 2008 that Lehman Brothers hid over $50 billion in loans by recording such loans as sales instead of liabilities. According to reports, the firm would usually raise cash by selling assets with a promise to buy those assets back in a short while. It was a common form of financing employed by the firm. And because the nature of the transaction was more of financing rather than a sale, the risky assets remained in Lehman Brothers' books. However, at the height of the 2008 financial crisis, it was reported that Lehman Brothers sold risky assets to banks in the Cayman Islands on a short-term basis, intending to buy back those assets. But instead of treating the transaction as a financing transaction as it used to do, the firm treated the transaction as sales, thus giving the impression that Lehman Brothers had $50 billion more in cash, $50 billion less in risky assets, and $50 billion more in sales. But as we all know, the Lehman Brothers eventually filed for bankruptcy in 2008 when this scandal was discovered. Another principal objective in auditing debts is to ascertain that debt is included on the balance sheet at the appropriate amounts and that interest expense is also stated on the income statement at the appropriate amount. This audit objective clearly addresses measurement. The Philippine accounting standards, whether it's full PFRS, PFRS for SMEs, or PFRS for SEs, are very clear on how financial instruments that include loans payable should be measured and how borrowing costs should be treated and recorded as well. Accordingly, not only should there be substantive audit procedures that will make sure that debts and related interests are recorded at the proper amounts, but the auditor assigned to audit debts should be knowledgeable about the requirements of the accounting standards as well. So the fourth audit objective is to ascertain that the debt on the balance sheet represents obligations of the entity at the balance sheet date. This principal audit objective addresses the obligations assertion. This audit objective is similar to the first audit objective we discussed earlier, in that this objective aims to ensure that all debts recorded in the books are valid obligations of the entity at the balance sheet date. For example, there are no obligations of other parties like the related parties that are erroneously recorded in the books of the company, or invalid obligations are recorded in the books of the company. For example, years ago, I had once a client who recorded loans payable based merely on the approval made by the board of directors to obtain loans from a bank. Although the actual loan has not been obtained yet, the accountant already erroneously recorded a loan based on the minutes of the board of directors meetings only. Suffice it to say that the client had weak controls over their financial reporting and monitoring processes. So the last principal audit objective in auditing debts is to ensure that debt is properly classified, described, and disclosed in the financial statements in conformity with prescribed accounting policies. The Philippine accounting standards require various information to be disclosed in the financial statements about loans payable and borrowing costs. Loans can also be classified as either current or non-current. Accordingly, the audit team should ensure that the appropriate audit procedures will be done to ensure the proper classification and disclosure of debts in the financial statements. So just to summarize, at the end of our audit of debts, we should be able to ascertain that the debts recorded in the books are valid obligations of the company, all completely recorded in the books at the proper cutoff date, stated and recorded in the books at the correct amount, real obligations of the entity, and properly described, classified, and disclosed in the financial statements. So let's now move on to our main topic, which is the typical substantive audit procedures performed on debts. Loans payable or debts, most often than not, comprise the largest portion of the company's total liabilities. Hence, appropriate and sufficient audit procedures should be performed on them. I would like to emphasize, though, that the substantive audit procedures we'll go through in this training session aren't all inclusive. As has been mentioned in previous training courses, not all clients are the same. The substantive audit procedures we will conduct should be tailored to the needs of our clients, and that only the typical substantive audit procedures will be discussed today. So having said that, let's briefly discuss each of those substantive audit procedures. The first step we need to take is to compare the balances of borrowings with those of prior periods and investigate any unexpected changes or the absence of expected changes. As you may already know by now, during the planning phase of the audit, we perform several procedures that would help us determine the nature, timing, and extent of our substantive audit procedures. Part of those several procedures is gaining an understanding of the important financial matters that happened in the company during the year under review. So for those who have joined yung planning meeting with the clients, I think they're familiar with this because we ask the clients a lot of questions during those planning meetings. In this regard, before starting the performance of the substantive audit procedures, we may already have expectations about the balances of debts at the end of the year. For example, based on our review of minutes of meetings and discussions with management during the planning phase of the audit, we may have come to know that 2 new large loans were obtained by the company during the middle part of the year and that no loan from the prior year was fully paid during the year. Accordingly, even before doing the comparison of balances as required by the audit procedure, we should have already an expectation that there will be quite a significant increase in loans payable accounts and also an increase in interest expense. Or it could be that during the planning phase, we may have come to know that the client had already fully paid at the beginning of the current year all its loans from the prior year. We were also informed by the client during the planning phase of the audit that they have not obtained a new loan since the full payment was made. Again, in this instance, we would already expect a 100% decrease in loans payable account balance and in interest expense even before the comparison of balances is made. So essentially, we gain or we have expectations already before even before the audit fieldwork. Nagkakaroon na tayo ng expectations based on what we have discussed with the client during the planning phase of the audit, not only through discussions with the client but also during our review of documents during the planning phase of the audit. Nagkakaroon tayo ng mga expectations kasi nalalaman natin kung ano yung mga nangyari sa client during the year. Accordingly, if the comparison of the current year loan payable balance with that of the prior year showed a change that we did not expect, for example, instead of seeing a significant increase in the first case, we see a decrease or even a no change in the account balance, then we need to investigate these unexpected changes. So if we are expecting to see, let's say, no, let's say a significant increase in loans because the client told us na nag-obtain sila ng malaking loans during the year. And yet when we see the balances of the loans at the end of the year, baliktad. Let's say nag-decrease instead of yung expectation natin ng increase, then that is something that we need to investigate. We can discuss these unexpected changes with the client immediately, or we can defer the discussion and just continue with the substantiation of the account balances, first to see whether any of the procedures we will perform can explain the unexpected changes. Whichever of these two ways we chose to do, we should at the end of the audit be able to get the explanation for the unexpected change or changes noted on the debts account. By the way, if there are no changes, if we noted no changes in the account balances, that doesn't mean that we don't have to investigate anymore. Kasi what that can only happen if our expectation is really there would be no changes in the account balance. But if we expected to see changes, to see movements in the account balance, and yet when we see the ending balances during our substantive audit testing, then that no change situation, circumstances should be investigated. Kasi hindi niya na-meet yung expectation natin. So we have to, so basically, what we investigate and what we do not investigate depends in part sa expectations natin during the year. The next step is to obtain a detailed schedule of loans payable, long-term debt, and related interest accounts by issue. By the way, if you have any questions, feel free to ask a question. The keywords here are by issue. This means that if the company obtained 5 loans supported by 5 different promissory notes, the schedule should show a total loan balance that is broken down into 5 different promissory note reference numbers or loan balances. The schedule at the very least should show for each issue whether the issue came from prior years or this year, the original principal loan balance obtained, the reference number for the supporting documents, the repayment terms, the security or collateral to the loan, if any, the interest rate, the amount of interest expense and accrued interest, the form of settlement, the amount of payment made during the year, and of course, the outstanding balance at the end of the year. The debt schedule prepared by the client should be marked with the words prepared by the client or PBC. Please do not forget these markings. This should be an automatic activity for us. When we receive any document from or any schedule from the client, mark it immediately as prepared by the client or PBC. And then the date the schedule was received from the client. So if we receive the schedule today, then we'll mark it as PBC and then June 8, 2021, something like that. We discussed the importance of these markings in the audit of cash. So if you are interested to know why we have to mark all work papers or schedules that we receive from the client with these words, then please you can refer back to the cash training video. But if you have any questions about this, just feel free to ask me as well. Anyway, going back to the schedule of debt, we should then verify the clerical accuracy of the schedule. We should check the propriety of the formula used by the client in coming up with both the vertical and horizontal totals, or we can also do the footing and cross-footing ourselves. So it's either we check the formula or we do the cross-footing. So ulitin natin yung formulang ginamit ng kliyente. Finally, the total loan balance presented in the schedule should be compared with the general ledger balance. Differences between the general ledger and the schedule balances should be investigated. Note that when the number of loans payable of the client is only minimal, like maybe just 1 or 2 loans, and there are no significant movements during the year, sometimes instead of waiting for the client to prepare the schedule, we can prepare the schedule ourselves based on the prior year work papers and or documents made available to us by the client. Pwedeng tayo na ang gumawa. And there's nothing wrong with that as long as the time used by us, auditors, in preparing the schedule does not significantly impact the efficient conduct of the other audit procedures. Because as you know, the time spent by us in preparing the schedule of debt could have been spent in performing other substantive audit procedures as well. But as I said, as long as the preparation of the schedule will not hinder the efficiency of the audit, then preparing the schedule of debts ourselves should be fine. So as long as hindi siya makakain ng maraming oras natin yung pag-prepare ng schedule, we can do it ourselves, especially kung wala nang maibigay na schedule sa atin yung client, naghihintay na lang tayo ng ibang schedule, then we can initiate and prepare the schedule ourselves as long as we have all the information needed. Pero kung magiging time-consuming yung paggawa ng schedule, then we should wait for the client to give the schedules to us. The next audit procedure we should do on debt obligation is to review board minutes, agreements, bank confirmation replies, and other documents to verify the authorization of long-term debt, to identify the existence of long-term lines of credit or similar obligations. As mentioned earlier, it is important to ensure that all loans obtained by the company, due to their typical large amount, as mentioned earlier, it is important to ensure that all loans obtained by the company were approved by the board of directors or by other authorized officers of the company due to their typical large amounts. Accordingly, we must read through minutes of meetings, agreements, bank confirmation replies, and other similar documents to ascertain that the loans of the company were duly approved by the board or other top management. Reviewing board minutes, committee minutes, or other correspondences can also possibly uncover unrecorded debts approved by the management or reveal undisclosed bank credit lines, guarantees, or securities to the debts, and other terms and conditions that are required to be reflected in the financial statements. Because sometimes yung client, hindi niya naibibigay sa atin lahat ng kailangang information. So, what we do is we refer to other documents that can possibly reveal to us these types of characteristics about the debts that we are auditing. So let's take the short audit case to understand further this particular substantive audit procedure. So let's do this case together. This is how to audit debts. So the case is, while reviewing minutes of board meetings and other documents, you noted that a recorded loan of 7 million pesos appeared to not have been approved by the board of directors. You are certain, however, that the loan was valid because you were able to inspect the covering loan agreement. You had known previously that as a company policy, any debt amounting to 5 million pesos and above needs the approval of the board. The balance of the loan is also above the engagement team's planning materiality. So the question is, will the lack of board's approval, there should be an apostrophe there, the board's approval of the loans lead to a modified opinion on debt? So this is relating to authorization. So walang approval yung loan na inobtain ng client. And we know that as a policy, the loan should have been approved by the board because it is above the threshold set by the company policy. So since it is above 5 million, the loan obtained was 7 million, and the threshold was for approval is 5 million. Should we modify our opinion on the debt balance because of this lack of authorization? So to answer that question, we have to investigate first why there was no noted approval on the loan. So we have to ask the client or examine documents if there are documents that can be examined for this. So pag meron tayong case na encounter na ganito, we have to ask the client or examine documents if there are documents that can be examined relating to this matter. Was the lack of approval just an unintentional omission on the part of the board? Meaning, hindi naman siya sinasadya. Note that in this instance, the lack of board approval does not automatically lead to a debt balance misstatement because it was clear that the recorded debt was obtained by the company. So yung case nga na ito is wala tayong problem sa debt balance kasi nakita naman natin na talagang na-receive nila yung debt. Nag-obtain talaga sila ng debt from the bank. So a modified opinion therefore may not be necessary to be performed on the debt balance as at the end of the year. So since wala namang misstatement sa debt balance, hindi natin kailangang i-modify yung opinion natin. Remember, our opinion covers the fairness of the balances of the account. And since totoo namang na-obtain, nakita natin, na-prove natin na talagang na-receive nila yung loan, nag-obtain sila ng loan from the bank, then walang misstatement ng debt balance. And therefore, there's no need to qualify our opinion. However, the lack of board approval should raise a red flag to us as this is a violation of important control over obtaining debts and a sign of weak corporate governance and monitoring controls. So it should be a red flag to us but not necessarily magli-lead na siya into modification of the opinion. Accordingly, we should ensure that this matter is raised and discussed with the audit committee or in the absence of an audit committee with the board itself. The matter should be included in the management letter as well. So dapat we have to raise this, elevate this to the information for the information of the management. We should also consider checking whether the lack of board approval could be an indication of fraud. So we have to also make sure na yung lack of approval is not an indication of fraud. So we have to consider a lot of things regarding this unauthorized obtaining of loan. So I hope this case is clear to you na pag ganito, remember that basically don't lose sight on what is our main objective at the end of the audit, which is to be able to express an opinion, a correct opinion on the financial statements of our clients. So in this case, Since wala namang misstatement ng debt, then there's no need for modification. But we have to look into this matter closely as well. Kasi baka may fraud naman talaga na nangyayari doon sa company. So let's move on to the next audit procedure. A very important procedure that addresses assertions such as existence, completeness, measurement, valuation, and presentation and disclosure in the audit of debt is to confirm debt obligations as to the amounts owed and amounts in sinking funds, if any, the collaterals, restrictions, and the debtor's compliance with the provisions of the agreement. That's our next procedure. Obtaining a confirmation replies for loans payable is a must procedure. Remember this is a must procedure for auditors because a third-party document coming from the creditors is still the best kind of evidence to support the audit. So when the audit team deems it more appropriate and efficient to perform direct substantive tests on loans payable, it may be best to send confirmation to all the identified bank lenders. As I said earlier, dishonest companies tend to omit or understate debts rather than overstate them. Accordingly, sending confirmation requests to all identified lenders may uncover omitted or understated loans payable. However, if the company has too many loans, pag masyado namang marami yung loans, we may consider sending confirmation for significant debt obligations only. So, hindi na natin kailangan naman na padalhan lahat ng may utang. Lahat ng utang nung clients natin. That is kung sobrang maraming loans. Identification of lenders can be done through review of minutes of meetings, contracts, or other agreements the company may have entered into. For example, a review of the purchase agreement covering several vehicles may indicate that such an agreement was a financing agreement after all. The bank confirmation request that was discussed in the training of cash can also possibly uncover omitted or understated loan payable balances. The bank confirmation request can confirm the existence and the balance of the outstanding loans payable of the company as well. Note, however, that just because we sent out bank confirmation requests doesn't mean that we no longer need to send a separate confirmation letter specifically for the loans payable balance. Similar to the confirmation request for other accounts, most auditing firms have a ready confirmation template for debts also. However, if you have no ready confirmation template with you, then you must ensure to prepare and customize a confirmation request where all the relevant terms and conditions such as collateral, interest rate, repayment terms, debt covenants, etc. of the debt can be confirmed by the lender. So, hindi enough yung bank confirmation request na pinapadala natin sa bangko to confirm yung debt balances sa libro ng clients natin. Depending on the controls of the company, a positive confirmation or a negative confirmation can be sent out by the auditors. Negative confirmation is when we only expect a reply from the lender if there was an exception noted. So, bali, sinasabi lang natin doon, mag-reply ka kung if you disagree with this confirmation. Positive confirmation is used when we want to receive a reply from the lender regardless of whether they agree with the information provided in the confirmation request or not. So, ito talagang hinihintay natin yung reply from the recipient of the confirmation letter. When using positive confirmation, we can also already fill in all the information we wanted to be confirmed on the confirmation request, or we can leave the information blank and request the lender to fill the blank spaces themselves. It is a matter of the auditor's professional judgment on what type of confirmation will be sent out to the lenders. However, I would like to point out that negative confirmation is rarely used, especially in the Philippine setting, where confirmation replies are not always received. Kasi dito sa Philippines, hindi naman lahat nagre-reply. So, we discourage actually yung use ng negative confirmation. I must also reiterate that sending confirmation requests to the creditors should be done by the auditors and not by the client. The client can help only in the preparation of the confirmation requests and nothing more. As also mentioned in the training for audit of cash, creditors and lenders usually look for the authorization of the client to confirm the requested information to auditors. Accordingly, the client's signature on the confirmation request is almost always required, and differences noted between the amount confirmed by the lender and the balance in the debt schedule should be discussed with the client. Based on the results of our audit procedures, determine if we can make a proper conclusion already as to the fairness of the debt obligation balances, or if we need to perform additional procedures. So actually, yung confirmation, hindi naman required supposedly yung pirma ng mga clients natin. We can actually prepare our confirmation request and then send them immediately directly to the recipient, to the intended recipient of the confirmation. Kaya lang kasi maraming recipient, let's say maraming debtors and creditors na gusto nila may pirma yung kliyente para ma-ensure na authorized yung confirmation request na nare-receive nila. So, that's why we still ask the client to prepare the confirmation request, tapos ibibigay na lang sa atin for sending out. Kasi para mapirmahan nila and mailagay din sa mga kung kailangan, if needed, sa letterhead nila kung kailangan. But essentially, generally, the confirmation request should be in the letterhead of the auditing firm or the auditors. So let's review this audit case together to learn more and better understand the confirmation procedure. Because confirmation is very important, let's take another case that tackles confirmation. For these case purposes, CY refers to current year while NY refers to next year. When asked for a list of the company's debt, your client provided you with this schedule of debt, which shows that the company has 3 loans. The first and second loans have original principal amounts of 10 million pesos, each with no principal payments made during the year. Hence, their outstanding balances at the end of the year were equal to the original principal amounts. The third loan, on the other hand, had an original principal amount of 7,500,000 pesos with a principal payment of 5 million pesos made on 8/18/20 CY, leaving an outstanding balance of 2,500,000 pesos at the end of the year. Your client also provided you with the following additional information about the loans. The first and second loans amounting to 10 million pesos each were covered by PN 0001 and PN 0002 respectively. Both loans are payable annually and bear an annual interest rate of 8% per annum. PN 0001 and PN 0002 were obtained on 11/20/20 CY and 10/9/20 CY respectively, and will mature on 11/15/20 NY and 10/4/20 NY respectively. The third loan for 7,500,000 pesos, which was obtained on 5/15/20 CY, is also payable annually, bears interest at 9% per annum, and will mature on 5/10/20 NY. Your client also provided you with all the promissory notes covering all the loans, and you found them all in order. So okay naman yung mga documents na supporting documents na binigay ng client. However, when asked to confirm the balances, your client requested not to send confirmation for PN 0001 for 10 million pesos because according to them, they are currently negotiating the loan with the lenders due to a dispute that arose during the year between them and the lender. So they requested not for the loan to be not confirmed. They are concerned that confirmation will jeopardize their negotiation. Anyway, they said they have provided you already with all the information and promissory notes you need. So would you accede to the client's request? Papayag ba tayo na hindi na lang ipa-confirm yung debt? And is that even allowed under the auditing standards? So the answer is, confirmation replies are considered the primary evidence to support debts as they come from third parties. However, there are certain circumstances where the auditor may allow not to send confirmation to third parties. So, ina-allow to ng auditing standard. Accordingly, the answer to this could be a yes or a no, depending on the auditor's professional judgment. If the outstanding amount is in dispute, the auditors, based on their professional judgment, may allow the non-confirmation of the loan kasi in dispute siya. So, pwedeng ina-allow yon under the auditing standards. However, the auditor should make sure to ascertain that the balance is really in dispute as the company claims, and should also know the nature of the dispute. In this regard, the auditor should obtain appropriate and sufficient evidence to substantiate this claim of dispute first. Hindi tayo basta-basta pumapayag. If they say na in dispute yung balance, kaya hindi ayaw nilang ipa-confirm, then we have to make sure na talagang in dispute siya, and we have also to know the nature of the dispute. If the auditor, after substantiating the claim, allows the company not to send confirmation, then sufficient and appropriate alternative procedures should be performed by the auditor to verify the loan balance, related interest, and other related information about the loan. So alternative procedures ang gagawin natin kung ayaw ipa-confirm, and we let the client not to send confirmation to the lender. However, should the auditor believe that it is not appropriate not to send confirmation to the lender, and yet the client continued to insist on not sending confirmation, then not allowing the auditors to send confirmation requests is considered a scope limitation that could be a potential ground for modifying the audit opinion. So if we think na hindi valid yung reason ng client for not sending confirmation, then we have to consider yung impact nung not sending confirmation to our audit opinion. In summary, our responses to the client's request for not confirming the loan hinges on our professional judgment based on our full understanding of the client's situation. So it all depends. Yung pag-allow natin for a client not to send confirmation, it all depends on our professional judgment based yun sa appreciation natin ng lahat ng information that we know about yung reason ng kliyente for not sending the confirmation request. So kung valid, we can allow, but if not valid, then we have to perform alternative procedures. And if dun sa alternative procedures, hindi pa rin natin ma-verify yung propriety of the loan, then yung modification sa audit opinion should be considered already. So I hope that is clear to all of us because I think may mga nagiging cases tayo na meron talagang client na nagre-request na hindi ipa-confirm yung certain balances. The next audit procedure we will discuss applies to new loans. Remember, these are new loans. In this procedure, we inspect original documents or authenticated copies of notes, debt agreements, or other related documents to determine the terms, restrictions, and other pertinent provisions. As mentioned earlier, in the Philippines, there is unfortunately a history of late confirmation replies or no replies at all from creditors and even debtors. Accordingly, it is advised that while waiting for the responses of the lenders, we should already perform alternative procedures by reviewing original copies or authenticated copies of the debt agreements supporting the new loans. Let me just emphasize that when inspecting debt agreements, we should thoroughly review such agreements for the various key terms and provisions of the debt agreements, such as principal, interest, maturity date, collateral, payment date schedules, and debt covenants that the company needs to comply with. So, I know of some auditors, siguro inexperienced auditors pa, na ang tinitingnan lang, pag binigyan ng debt loan agreement, ang tinitingnan kagad yung page na kung nasaan yung loan balance, kung magkano yung loan. That is not how we examine debt agreements. We should read the debt agreements ng buo. We have to have the complete loan agreements with us. When the client gives us just a page or two of the loan agreements, make sure to go back to the client and ask for the complete loan agreement. And then we have to read the agreement from the first page down to the last, to the annexes, kung merong pang annexes, because that is where, because sometimes nandun sa mga pages na yon, any of those pages will reveal yung mga, or uncover, or we will be able to read some of the terms and conditions of the loans na may effect pala sa financial statements nung company. Like for example, baka may mga debt covenants na hindi natin pinapansin, meron pala nasa ilalim, or hindi binigay ng kliyente yung page ng mga debt covenants. So therefore, hindi natin din, kumbaga sa ano, when they prepare the FS with no debt covenants, inallow din natin kasi wala naman, hindi natin alam na may debt covenants pala. But had we been given the complete loan agreements, we would have known na merong debt covenants na dapat na dinidisclose sa FS. So make sure when we are given a loan agreement or a debt agreement, wag lang yung amount ang tinitingnan natin. Wag lang yung amount ng loan ang tinitingnan natin. Tinitingnan natin lahat ng provisions na nandun sa loan agreement. Where the debt balance came from prior years that has been audited by the same auditor or audit firm before, in cases where na-audit na natin siya in previous years, then we can just perform a roll-forward analysis of the loan balance by tracing to prior year work papers the beginning balance of the debt obligation and then accounting for the movements in the current year of the debt obligations, such as payments to arrive at the ending balance. So if dati ng loan siya, meron lang movements during the year, let's say may mga payments na ginawa, we can do a roll forward analysis already. We then perform another audit procedure, which is to support the principal payments made by the company through inspection of canceled checks, bank statements, check vouchers, bank debit notes, and other relevant documents. Similar to confirmation, differences noted between the results of our inspection of documents and the balances in the debt schedule should be discussed with the client. We should then assess the client's responses and determine if we need to perform additional procedures. Sometimes I know that we are given by the client yung GL nila. The client gives us yung GL, parang GL movement of the account. And I know then that a lot of times we prepare the roll forward analysis based on the GL movement, which is fine. Because we can really use the GL movement to prepare the roll forward analysis. However, I just want to emphasize that when the movements during the year pertain to, let's say, additional loans obtained and payments made during the year also, kailangan yung movements, both yung additional loans and the payments, dapat yung mga supporting documents na yun, tinitingnan natin pareho. So, hindi lang yung additional loans ang titingnan natin, like, we'll just get the loan agreements for the additional loans. We also have to make sure na pag nilagay nila na nagbayad sila, let's say, ni-record nila sa GL nila, may payments silang ginawa. We have to make sure na to review also yung documents evidencing na talagang nagbayad sila. Hindi pwedeng, since naggawa na natin based on the GL movement, tapos na yan. Hindi ganon. We have to make sure na ina-examine natin yung movements during the year, both yung increases and yung decreases, especially kung significant yung mga amounts na yon. So, it is the long-term debt agreements that typically contain debt covenants. For those who are new to this term, debt covenants pertain to the set of rules imposed by a lender which the borrower must comply with. Debt covenants could be positive or negative. So usually, pag short-term loans, wala tong mga debt covenants. Yung mga long-term debts lang ang merong debt covenants. Positive covenants are those actions which the company or the borrower must do. An example of a positive covenant is the achievement of a certain threshold in certain financial ratios, such as the current ratio of, say, no less than 1:1, or a debt-to-equity ratio of, say, no more than 1.5:1. Another typical example of a positive covenant is the submission of the annual audited financial statements by the borrower to the lender within an agreed period. So these are the to-dos of the borrower. Conversely, negative covenants are those actions which the company or borrower is prohibited to do. So these are the don'ts. Examples are the prohibition to declare dividends until the loan is fully paid and the prohibition to obtain additional loans until the long-term debt is paid. Those are examples of negative covenants. Violation of debt covenants typically results in sanctions from the lender. Sanctions can include, among others, immediate demand for full principal repayment, increase in the interest rate, increase in collateral, etc. As you can see, violations in debt covenants can affect the classification and disclosure of debts in the financial statements. It can even raise a going concern issue for a company if the lender demands the immediate full payment of a large debt obligation for which the company has no immediate cash and assets to pay with. Accordingly, it is important that we not only know and document in our work papers the debt covenants but we should also review the calculations and other evidences relating to compliance with debt covenants or other provisions of the loan agreements. Accordingly, we should obtain the company's covenant calculations and compliance certificates submitted by the company to the lender. If there's any non-compliance noted, such violations should be discussed immediately with the appropriate officers of the company. We should also determine and document any additional procedures we need to perform for the noted non-compliance. For example, obtaining, if necessary, written waivers from the lenders or determining whether the borrower is given a grace period within which the violation can be cured. So, debt covenants, knowing the debt covenants of a long-term debt or long-term debts of the company is very important because it can impact yung liquidity ng company and also the disclosure requirements of the standards because debt covenants are required to be disclosed in the financial statements, but more so because of yung potential impact nung non-compliance with debt covenants to the liquidity of the company. I know of a company before na hindi siya nakapag-comply sa debt covenants niya and na-force siya to classify all his long-term loans into current. And because lumabas na wala siyang assets to pay for all the loans, napilitan siyang mag-file for bankruptcy. Nag-Chapter 11 filing siya because of the company's failure to meet the debt covenants of the lender. So, here's an example of what you may encounter during your audit of debts. Let's review this audit case together. So you noted during your audit that your client breached a provision of a long-term loan agreement on or before the end of the reporting period with the effect that the loan becomes payable on demand. However, your client insisted that the long-term debt should not be reclassified as current because the lender already agreed after the reporting period not to demand payment as a consequence of the breach. The client gave you a copy of the lender's notice of non-demand of payment. So in this case, would you still continue to propose a reclassification of the debt to current kung meron naman ng binigay na notice of non-demand of payment yung lender? Would we still continue to insist on reclassifying the debt from long-term to current? The answer to the question is yes. The loan still has to be classified as current because the lender agreed not to demand payment after the reporting period. Therefore, at the end of the reporting period, meaning kung December 31 siya, binigay nung lender yung non-demand of payment after December 31. Therefore, at the end of the reporting period, the client still does not have an unconditional right to defer the loan settlement for at least 12 months after the reporting date. So, kung naibigay nung lender yung demand for non-payment on or before December 31, then the answer to this would be no already. But because binigay siya after the year-end date, therefore, hindi pa magte-take effect lang yung non-demand of payment after December 31. So as you can see here, as auditors, it is imperative that we know our accounting principles when performing audit procedures on debt or any account balance for that matter that we are auditing. So napaka-importante talaga that we know our accounting standards and accounting principles. Otherwise, accounting errors may already be staring us in the face, and yet we are still not able to detect the same, which would be a shame and unfortunate. Situations like this not only reflect on the competence of the auditors, but it will also affect the effectiveness and efficiency of the audit as a whole. Kasi baka kuminsan, mamali tayo dahil nakita natin yung demand for payment, pumayag tayo dun sa gusto ng kliyente na um, wag nang i-reclassify to current liability yung debt. So, kung hindi natin alam accounting standard, if we are not really that knowledgeable, baka pumayag tayo, as I said. Pero kung alam natin, then we know that the client still has to reclassify, even if binigyan na niya tayo ng notice for non-demand of payment. Sorry, the non should be without E. So, let's discuss another substantive audit procedure, which is to review refinancing agreements and loans payable transactions after the balance sheet date to determine their effects on balance sheet classification or non-disclosure. To perform this procedure, initially inquire from the client whether a refinancing arrangement occurred during the year or the following year. Also, review the minutes of meetings and other correspondences to identify any refinancing of loans made by the company, if any. If a refinancing of loans occurred, ensure to review the refinancing agreement and then assess the accounting impact of the provisions of the debt refinancing in the books of the company. As you maybe are aware, accounting for debt refinancing is not as straightforward as accounting for and recording a new loan. Iba ang debt refinancing. Debt refinancing can either be a debt exchange or a debt modification. It can either result in the extinguishment of the existing debt accompanied by the rise of new debts, or it can result in just a continuation of the existing debt. So, with the debt exchange, nawawala talaga, na-extinguish yung debt. Pero sa debt modification, nandun pa rin yung debt, nag-change lang yung terms and conditions niya. And whatever the case, whether it is a debt exchange or a debt modification, it has its accounting implications. Accordingly, audit of debt refinancing requires solid knowledge of the proper accounting treatment of this particular transaction. In this regard, for an efficient and effective audit, the audit of debt refinancing should be assigned to an auditor who has the appropriate level of experience, skill, and accounting knowledge about this particular matter. We should also determine whether any subsequent event that transpired relating to debt obligation should be disclosed or adjusted in the financial statements. So, ibang debt refinancing sa full payment of debt, ha? Make sure na nadidistinguish natin ang debt refinancing from the usual debt payments. Another procedure we should do on debt obligations is to review the short-term and long-term classification of debt for propriety. You would have most likely guessed at this point of the training that proper classification of debt, that is current and non-current, is critical to the financial statements of clients as they will affect how the stakeholders view the financial health of the company. Companies with lower current liabilities are generally considered healthier than those with more. Accordingly, As auditors, we must ascertain that the non-current and current portion of the debts is properly calculated and disclosed in the financial statements. To test this, auditors recalculate the current and non-current portion of the debts based on their related maturities and amortization schedules. So we should not forget to test. Pag nakakakita tayo ng long-term debt sa libro ng mga clients natin, we have to make sure that we test whether all the long-term debts are properly classified really as long-term. Baka merong portion doon na current. The calculated amounts are then compared to the loan balances recorded in the company's books. Note that refinancing agreements and debt transactions, if any, after the balance sheet date should also be reviewed by auditors to determine their effects on balance sheet classification or disclosure. The last audit procedure we will discuss regarding loans payable is to perform an overall test of the reasonableness of interest expense and related accrued interest payable. Once we are satisfied already regarding the correctness of the principal balances of the loans payable recorded in the books as at the cutoff date, we can now test for the reasonableness of the related interest expense and accrued interest payable. So, okay na tayo sa principal, we will now move on to the related interest. Please note that the operating word is reasonableness. We are only after the reasonableness and not the accuracy of the recorded interest expense. Multiplying the average interest rate by the average amount of debt outstanding is an example of a test of reasonableness calculation. However, it should be emphasized that auditors are allowed to use other ways of testing or calculating for the reasonableness of interest as they see fit for their clients. Some auditors, ang tinetest nila yung interest rate, sometimes yung absolute amounts. Yung way of calculating the interest also varies. So it all depends on how the auditors, on the auditor's judgment, kung anong tamang pag-test ng reasonableness ng interest expense. So to help us further in understanding how debts or loans payable are audited, let's work on this case together. I will call this the case of ABC Corp. This was an actual audit case I had abroad years ago, but the situations and locations were changed. I will read the case to you and will flash here the significant information provided about the case. So at the end of this case, we will discuss certain situations and answer some related questions to those situations. So the case is, ABC Corp is a medium-sized company that is engaged in manufacturing snack foods made from sweet potatoes. Its original manufacturing plant is located in a beautiful town south of Metro Manila. The company's main office is headquartered at the BGC. The company developed a potato-based snack that became a massive favorite among snack lovers. Their profit almost doubled in just a year. The top officers of the company were so stoked about the massive demand for their products that they thought of expanding their operations through vertical expansion with plants and operations to be spread not only in Luzon but also in the Visayas and Mindanao region to reduce freight and distribution costs, and more importantly, to have a more efficient production process that will eventually lead to lower costs, very competitive selling prices, and bigger chunk in the snack market. So, kasi before, ano lang sila, purely manufacturing. Now, gusto na nilang mag-expand na sila na rin yung gagawa ng raw materials nila. As part of its vertical expansion, The company thought of entering the potato supply market so that instead of buying potatoes from third parties, the company will buy sweet potatoes from its own farms for the supply of their snacks' main raw material. The top officers then proposed the vertical expansion in various locations to the board of directors. Part of the proposals made to the board is to obtain short-term and long-term loans from banks to finance the proposed expansion. So, uutang sila. The board of directors was successfully convinced by the top management of the viability of their proposal. So they approved the proposed expansion and appointed the president and the CFO to negotiate with banks for the loans to be obtained. So it didn't take long for the president and the CFO to get the loans totaling 350 million pesos from two banks, XYZ Bank and QRS Bank. The following are the details of the loans obtained by the company. QRS Bank granted the company a revolving loan amounting to up to 100 million pesos, with each loan drawing to be payable over 1 year and bears interest at 7% per annum. The revolving loan is collateralized by certain company property and equipment and inventories. A revolving loan, for those not familiar with it, is a type of loan where the borrower can draw, repay, and redraw the loans again. So, parang nag-revolving nga siya. So, uutang ka, babayaran mo, uutang ka, uutang ka uli. Parang ganun ang revolving loan. XYZ Bank, on the other hand, granted the company a long-term loan totaling 250 million pesos, payable on equal installments for 5 years, with the first installment payment due the following year. The loan bears interest at 10% per annum and is collateralized by certain property and equipment of the company and personal guarantee of two of the company's major stockholders. There were also debt covenants required for the company to maintain a current ratio of 1:1 and a maximum debt to equity ratio of 2:1. The company is also prohibited from declaring dividends until the full payment of the long-term debt. A violation of any of these financial ratios will result immediately in having the full payment payable on demand, the full loan payable on demand. Once the funds became available, the company started its expansion activities and bought a couple of large farms in Cebu and Davao. They also hired the necessary employees to operate the farms and also started to build plants and offices in Cebu and Davao. The company also purchased the needed machinery and equipment for the operation of the farms, plants, and offices. With this setup, the company was able to meet its sales forecast for the following year and thus was able to service its loans on time. So, naging okay naman yung results ng operations nila, yung performance nila. So, nakabayad sila nung long-term debt on time. It repaid then its revolving loan from QRS Bank and redrew the same amount. So, binayaran nila yung 100 million, tapos nagkuha uli sila ng another 100 million. The company also paid the first installment payment of the principal of 50,000 due to XYZ Bank. This is the long-term loan and the related interest. However, in the following year, cheaper sweet potato snacks from other countries suddenly flooded the local market, resulting in the company failing to meet its sales forecast. So, biglang nag-flood. Bumaha ng sweet ng mga snacks na similar doon sa products ng company dito sa Pilipinas. So, naapektuhan yung sales nila kasi mas mura yung mga imported. The company, therefore, had difficulty in paying its loans and related accrued interest payable. And because hindi nila na-meet yung target sales nila, hindi sila nakabayad ng loans nila and the related interest. At this juncture, which is the second year of the loans with ABC Corp, you have been assigned by your team to audit the loans payable account of the company. The client provided you with the following schedule as of December 31, 20 CY of the loans payable balances. You immediately mark the schedule with the words PBC, since you are a diligent auditor, and the date you received the schedule. You also index the working paper and tied up the total loans payable with the general balance. So, i-assume natin na tie up to sa GL. So, you sent a confirmation request to XYZ Corporation, XYZ Bank, and QRS Bank. Based on your prior year's experience, these banks did not reply immediately to confirmation request. Last year, so yung first year ng loan, nagsend rin tayo ng confirmation kay XYZ and QRS Bank, and hindi sila nag-confirm on time. Accordingly, you thought it best to immediately perform alternative procedures to verify the loan balance while waiting for the confirmation reply. So how would you verify the outstanding balance of the loans payable as of December 31 CY while waiting for the confirmation reply? I think we should all know this, the answer to this first question. But my suggested response is, since there was no movement in the account balance during the year, meaning wala namang bagong loans other than the revolving loan, since there was no significant movement in the long-term account balances during the year, we can just trace the principal balances from prior year work papers. We don't need to examine again the same loan agreements we already examined in the prior year. However, we should verify by examining sufficient and appropriate evidence the receipt of the proceeds of the redrawn revolving loan. So for the long-term loan, we don't need to examine the loan agreements again because na-examine na natin yan in prior years. But for the new revolving loan that was just redrawn during the year, then we have to examine sufficient appropriate evidence na na-receive nga nila and nag-obtain sila ng bagong revolving loan from XYZ Bank. And to ensure that there are no new loans obtained by the company that was not recorded in the books, we should also review minutes of the board meetings and correspondences to note for the possibility of new but unrecorded loans obtained, and of course, follow up and ensure to get the confirmation replies from the lender. So, make sure na kahit na na-examine na natin yung mga documents, yung mga loan agreements, that we still have to follow up and obtain the confirmation reply from the banks because as I said earlier, the confirmation replies are the best form of evidence for debts because they came from the bank itself. So you recalculated the financial ratios required to be met in the debt covenants. Based on your recalculation, you noted that the company exceeded the threshold of the debt-to-equity ratio. So you discussed the matter immediately with the chief accountant who told you that they expected that such will happen and therefore already went to the bank to discuss a possible violation. So nag-initiate na raw sila. Sila na mismo nagsabi sa bangko na they will not meet certain debt covenants. Therefore, according to the chief accountant, XYZ Bank is already aware of the violation to the debt covenant. So, in this case, what will you do with the information provided by the chief accountant? So, okay na ba yun sa atin? Na sinabi niya na aware na yung bangko. Aware naman yung bangko doon sa violation ng debt covenant and therefore wala nang dapat na gawin pa. Well, awareness of the bank is different from waiver of non-compliance. The bank could be aware but still demand the full payment of the loan due to the violation. Accordingly, as the auditors, you will need to still obtain from the client a waiver from the bank of non-compliance with the debt covenant. So, iba yung aware sa waiver. So, kasi yung unang, sinabi lang ng chief accountant, alam na nung bangko. Pero that doesn't mean na kung alam ng bangko na wini-waive na rin nila yung non-compliance with the debt covenant. Therefore, kailangan kung aware, dapat may kasunod yon, which is yung waiver of non-compliance and the waiver of non-compliance should be covering talaga, magagamit natin for our decision, for us to make a decision na tama nga na walang dapat nang gawin or wala nang dapat na reclassification na gawin about the long-term debt. So, depende pa rin yun kung anong laman yung waiver na ibibigay ng bangko. So, we have to read carefully kung paano winord yung wording ng bangko about the waiver. But anyway, so for this particular situation, hindi enough yung aware lang yung bangko. The client could not provide you with a copy of the non-compliance of debt covenant and could not show any other proof that the bank will not exercise their option in case of non-compliance. You also could not confirm the client's claim of waiver with the bank, but not because the client prevents you from doing so, but because the bank does not want to deal with auditors directly regarding any debt covenant compliance issue. So dito, gusto natin, sana, tayo na lang magko-confirm sa bank kung talaga bang wini-waive na nila yung violation ng company. But the bank does not want to deal with the auditors directly. So what will you do pag ganito yung situation? For this question, here's my suggested response. Because of lack of appropriate evidence that will support the client's claim that the bank already waived the non-compliance, you will need to propose a reclassification entry of the term loan from non-current liability to current as per debt covenant and ensure that a disclosure is made in the financial statements of the non-compliance and the subsequent reclassification of loans. So in the absence of any supporting document, supporting evidence, other than yung sinasabi ng kliyente, we need to stand our ground and continue to propose a reclassification entry. But what if the client refuses to take the proposed reclassification entry from non-current liability to current liability as they were adamant that the non-compliance had been waived already? So ayaw naman nilang pumayag. Ayaw nilang pumayag, at the same time, hindi rin sila makapagbigay ng proof. So what will you do? My suggested response is, you will need to assess the impact of the company's refusal to take the reclassification on the audit report already. If deemed material, a report other than a clean opinion may need to be issued regarding the company's financial statements. So, in this case, dapat na nating i-consider kung dapat tayong qualify ng opinion or not. Otherwise, unless makapagbigay yung kliyente ng proof na talagang nagkaroon ng waiving of debt covenants, violation to debt covenants. Finally, what other impact on the financial statements may the difficulty in paying the loans payable entails. So remember, hindi makapagbayad yung utang. So what other impact on the hindi makapagbayad ng utang yung kliyente natin. So what other impact on the financial statements may the difficulty in paying the loans payable entail? For this particular question, here's my suggested response. You and the rest of your team should consider assessing if the company already has a going concern issue as a result of the impact of the stiff competition that resulted in lower sales and difficulty in paying obligations. Your team should also ascertain whether adequate disclosures regarding this matter were made in the financial statements. So dapat humingi tayo ng mga supporting documents na wala silang going concern issue, like sales forecast for the next, let's say, 5 years. Paano nila nakikita ang sarili nila in the next 5 years? Like, kaya ba nilang bayaran yung loans nila? Will they be able to increase their sales? Where would they get the money to pay off their huge loans? Yung mga ganun. So we have to make sure na to examine in more detail, yung going concern issue nila, kung meron silang going concern issue. So pag may mga clients tayo na hindi makapagbayad ng loans, dapat automatic tinitingnan natin yung going concern issue ng kliyente. Bakit hindi sila makapagbayad ng loans? Yun muna ang unang tanong. If it's because of declining performance of results ng operation, then definitely we have to ask for supporting documents from the client na wala silang going concern issue, which means mga cash flows analysis for at least the next 5 years maybe. Minimum, siguro minimum, in practice, minimum of 5 years ang hinihingi natin for cash flows. And then the cash flows, hindi lang pag binigay yung cash flow sa atin, okay na tayo. We have to test kung tama yung cash flows na binigay nila. So essentially, yung mga assumptions na ginamit nila ron, like for example, kung nilagay nila 5% increase in sales every year, for the next 5 years, we have to know and be certain na tama yung 5%. So we have to make maybe tayo rin mismo, gagawa tayo ng mga benchmarkings kung tama yung 5% nila. So I hope this comprehensive case helped you understand how to apply the substantive audit procedures we just discussed. So actually, tapos na yung training, but let's cap off or finish this training session by discussing the following common auditing issues relating to the audit of debt obligations. These are different from the common risks we discussed earlier. The common risks are the risks we should be alert for during our audit. So yung una nating tinakal kanina, those are the risks that we should be alert for during the course of our audit, yung dapat nating binabantayan. These auditing issues are the common issues we encounter in the execution of our audit procedure. So these are the common parang difficulties or problems or issues na na-encounter natin during the audit of debt. But similar to common risks, these auditing procedures are not all inclusive. So ilan lang to doon sa mga na-encounter natin during our audit of debt. So here are the auditing issues we will briefly discuss to end this training session. One is significant variances between debt obligation schedule and the general ledger. No confirmation replies received or late receipt of confirmation replies. Missing loan agreements due to weak file management. Client did not want to reclassify their long-term debt to current as a result of non-compliance with debt covenants. I think we already discussed that in detail. Difference between supporting documents and the amount of debts recorded in the books. So let's discuss each one briefly. First is the significant variance between debt obligation schedule and the general ledger. It could always happen, depending on the lack of effectiveness of a company's internal controls, that the details of debt obligations deviate from the balance presented in the general ledger. In instances like this, we should discuss the matter with the client and assess the plausibility of their response. For explanations that do not make sense to you, or when the variances are significant, obtain reconciliation statements from the client. Then substantiate the propriety of reconciliation by inspecting documents on significant or unusual reconciling items. So, as I have said, whatever we ask the clients, we should always substantiate their responses. Hindi natin tinatanggap as is yung mga explanations ng client. We are expected to perform other procedures to validate yung response na binibigay sa atin ng client. The next auditing issue is no confirmation replies received or late receipt of confirmation replies. One of the most common issues, or maybe things that could snag the audit of debt or delay the audit of debt obligations, relates to sending confirmation. So we have learned earlier that similar to the audit of cash and receivables, sending confirmation requests to creditors and lenders is a primary procedure in validating liability balances as well. However, as has been mentioned multiple times, based on past experiences, not many creditors reply to confirmation requests here in the Philippines. Either the confirmation replies are received late or the lenders do not confirm at all. Accordingly, we should always ensure that follow-ups for the replies are often made. Because of the speed or slowness, for lack of a better term, in receiving confirmation replies, the automatic performance of alternative procedures, such as review of loan documents and similar agreements, becomes somewhat a must while waiting for the confirmation replies, if any, to come in. So we have to make sure na we follow up the replies. Hindi pag sinend out natin, okay na tayo. We have to make sure na before we leave the client, before the field work ends, meron na tayong confirmation reply. We can ask the client to follow up yung bangko kasi sometimes yung mga lenders, they really do not want to, especially since loans to, so medyo sensitive, ayaw nilang nakikipag-deal directly sa auditor. So we can ask the client to follow up the banks or the lenders to reply to us directly. Dapat ang follow-up would be, yung client, follow-up lang siya. Hindi siya pwedeng ibigay sa kanya yung reply. Dapat sasabihan lang niya yung bangko to reply to us or to confirm to us na the balance directly. Hindi pwede nila sabihin na ibigay niyo sa amin, tapos kami na lang magbibigay sa auditor. Bawal yon. Or hindi, nangyayari yon. Hindi, bawal siya pero nangyayari. So we have to make sure na hindi siya mangyari pag tayo na yung nandun sa situation na yon. So we have to make sure na yung client, aware siya na hanggang follow-up lang siya. The other common issue is missing loan agreements due to weak file management. So it must be admitted that there are some companies, especially the smaller ones, which have unfortunately weak filing systems. Medyo common ito sa ibang companies. There have been instances where the auditors are ready to perform alternative procedures already, but the related loan agreements could not be found, or if found, were incomplete. This, coupled with a lack of confirmation replies, unfortunately results in a delay in the completion of the audit or modified opinion due to scope limitation. Accordingly, when matters such as these had been identified by the audit team during the planning phase of the audit, substantive audit procedures should be designed to ensure that the audit will not encounter delays during the substantive phase. For example, agreeing with the client that they should have already all the required and complete loan agreements before the substantive fieldwork begins. So dapat, when we become aware of issues like this, alam na natin na magulo yung documentation, yung filing system ng kliyente. dapat sa ano pa lang, sa before the start pa lang of the audit, which could be during the planning phase, nakikipag-deal na tayo sa kliyente na to make sure na walang delay na mangyayari sa audit because of their weak filing system. So pwede nating sabihin sa kliyente, we will not start the audit until you have all the complete documents available for our review. Hindi kami papasok ng hindi kompleto yung documents ninyo. Kasi pag pumasok tayo, na kulang-kulang documents niya, madidelay lang na madidelay yung audit. And no, actually, malulugi tayo as the auditors kasi para tayo kasing taxi, that's the truth. So, pag once na pumasok tayo sa kliyente, para tayong metro na nag-i-increase yung time charges natin. So, kung wala naman tayong, hindi naman tayo productive dun sa time charges na binibigay natin because wala na, not because hindi tayo nagtatrabaho, but because walang maibigay na tamang documents or schedules yung kliyente, then yes, may impact sa kanila dahil nadidelay ang FS nila. Pero meron ding mas malaking impact sa atin dahil hindi naman yung time charges, malulugi tayo. Kasi when we estimate our fees, we usually assume not lahat may kompleto yung documents ng kliyente. Ganun palagi yung assumption na maibibigay nila on time as agreed yung mga documents na napag-agreehan natin. So kung hindi nila maibigay, malulugi tayo. So we have to make sure na meron tayong previous agreements na with the client with regards to how we will execute the audit procedures later on. The next common auditing issues that we encounter is when the client refuses to reclassify their long-term debt into current because of non-compliance with debt covenants. So I think marami na sa inyo yung naka-encounter nito kasi ayaw nga ng clients na short-term ang mga liabilities nila because it affects their working capital ratio. There have also been instances when a company which failed to comply with debt covenants did not want to change the classification of their long-term debt to current liability when the provisions of the debt agreement call for such reclassification in cases of non-compliance. In events such as this, the auditor must require the client to present to the auditor a waiver of non-compliance from their lenders for the period under review. Without the waiver, we should consider standing our ground about reclassification. Should the client insist on maintaining the classification of the liability as non-current, then the auditor should evaluate the impact of the company's rejection of the proposed reclassification on their audit report already, especially when the debts are significant. So I think kapag na-discuss na natin ito in detail earlier, so we will not expound on this more. And finally, to complete this audit training session, the last auditing issue we will discuss is the occurrence of differences between supporting documents and the amounts of debts recorded in the books. It could also happen that discrepancies between the supporting documents such as loan agreements provided to you by the client and the balances recorded in the books will be noted. So, magkaiba yung nasa supporting document saka yung nakalibro. Any discrepancy noted should be investigated by auditors and should be resolved before the end of the audit. So, dapat ma-resolve siya. Any unresolved differences should be assessed for their impact on the audit opinion. So, any differences, pag may mga differences, especially pag malalaki, we have to always ask the client to reconcile those differences. Or we can make our own investigations. Whatever the case, at the end of the audit, dapat comfortable tayo doon sa balanse na nasa libro. Kung ano man yung nakita nating supporting documents, differences between the supporting documents and the books, and the amounts recorded in the books, then as long as we are comfortable and we are able to determine na tama na yung nasa libro, then that's it. Dapat resolve na yung issue, basically. Pero pag hindi natin ma-resolve yung issue, then we have to ma-resolve yung differences, then we have to consider yung impact ng differences na yon sa audit opinion natin. Like for example, kung may malaki tayong malaki yung nasa loan agreements na binook, let's say 1 million yung nasa loan agreement, ang nasa libro 500,000 lang, and the 500,000 difference is material to us, then we should first, of course, is propose an entry to recognize the 500,000, but we cannot just say na debit cash and credit liability because yung cash, na-audit na natin yun. Remember, kung most likely na-audit na natin ang cash. Therefore, kung na-audit na natin ang cash, hindi natin na pwedeng galawin yung cash sa proposed entry natin for debts. So it could, the debit to the entry, crediting the liability for na nagre-recognize ng 500,000, hindi pwedeng cash. It could be other accounts which we need to investigate together with the client, or kung kaya natin based sa mga na-audit na nating accounts. Kasi possible na during our audit of certain of other account balances, baka lumabas siya. Makikita natin na doon pala siya pumasok, doon sa account na yun. So therefore, pwede na tayong mag-propose ng tamang adjustment. But in case lang na bigla na lang na nating nakita na merong difference between the loan agreement and the amount recorded in the books, hindi tayo pwedeng basta-basta mag-adjust ng kung ano-anong account. Dapat when we propose adjustments, we are sure na tama yung nakadebit, tama yung amount na nakadebit, tama yung amount na nakakredit, tama yung account na nakakredit, and the related amount is also correct. So thank you very much.